Welcome, ladies and gentlemen. Welcome back. And one of the questions that we recently discussed with Steen Jacobsen of Saxo Bank, and the question that is really the number one question in everybody's mind, that's the Fed policy and its impact on the securities markets around the world. And Steen was quite skeptical about the powers of the Fed and the way the market actually sees the Fed. But from the global standpoint, is it still a factor? Because quite recently, investors seems to be kind of disregarding this element, and especially the bonds. I mean, when they only look at the bonds in terms of the tapering without any of the details. I was wondering, speaking of the Fed as a force, is it changing? Is it evolving? Yes or no? What's your take on that?
Well, the Fed is always important as the effectively the central bank for the world's global reserve currency. But I think Steen is right in pointing out that what we're looking at here in terms of the Fed's powers is they have very limited ability to actually change anything, because we're looking at an economy that's suffering from supply constraints. And whether the Fed is at 0% policy rate or at a 2% policy rate, they maybe can print more dollars, but they can't print natural gas, they can't print oil, they can't print copper, and the things that are in short supply around the world for moving the economy forward, the things that are holding the economy back. So I think in many ways, sure, markets would be upset if the Fed were to suddenly hike interest rates, but in many ways they have the least amount of power that they've had in a long time. So that's my general view on where the Fed is at this point in time. Whether they taper tomorrow or 6 months from now, I don't think that's really the thing that's going to affect the economy. Could affect global markets to a degree, but not the economy.
Well, okay. Well, in that case, I remember the ECB actually cut off one of these because they say that there's the bonds, right, one arm, and then the rates, two arms. ECB back in the day actually is like a one-arm dude. They only manage the bonds. Then can the Fed follow the ECB track, basically cut off one arm, and the fact that this whole rate is no longer the tool for the Fed, it's just buying back assets and bonds? Could it be the same?
I think it could only be the same if the U.S. government was having a hard time funding itself. In other words, that would be only in evidence if you saw interest rates rising rapidly to a degree that the Fed thought this is going to crater the economy. We need to step in and make sure that interest rates are capped. Otherwise, the economy is going to crash. As it is now, the Fed is buying all of these bonds and treasuries, but the demand for treasuries is so high that it actually had to lend those treasuries back out. So it has $1.5 trillion of treasuries that it has lent out, treasuries that it bought, and then it's lending them right back out. So even if all asset purchases stopped tomorrow from the Federal Reserve, they have another, let's call it 1 year of QE already stored up in this so-called reverse repo facility. So I think this scenario you discussed comes about only in a very different environment where they're concerned that rates are rising too fast at the long end of the curve, and they need to control the yield curve to avoid an impact to growth.
Okay, well, in that case, let me come back to my talk with Steen Jacobsen, and he basically says that the Fed has never done the social function. Now, the Powell actually, thinking about inequality, employment, the whole social thing. Is it true? Is it really changing the nature and the efficacy of the Fed as an entity?
I think they see this as a very important political point to make, that they claim that they're trying to keep interest rates low because they think that it is helping all corners of society by maximizing the economy's growth potential. They're maximizing employment opportunities. But many of us can look at what they're doing and say that by keeping these interest rates so low, that it rewards wealth, it rewards the already wealthy by keeping asset prices high and going higher, especially housing. So actually that they're driving the very opposite of what they're saying. And that's actually what we believe they're doing as well. So it's basically something they're signaling. It's not something they're doing. And does the central bank have the tools to address this problem? I don't think so. this is the government, this is the fiscal authority that if it wants to create policy that helps the lower end of the income spectrum, that would help to drive. And in fact, the Fed could do most to help the situation by, over the long run, normalizing policy. That's impossible to do right now. They would completely crash global markets if they were to normalize interest rate policy. So it's talk. They're not walking the walk, they're talking the talk on this issue.
Yeah, and the last question about the Fed that I have for you. We've seen the senators, headed by Elizabeth Warren, a group of senators that are currently attacking Powell, and not just Powell, but also, his deputies, right? They're demanding an investigation on the insider trading. So, John, where do you see the end of it? How will this unravel?
Yeah, it's a great question. Because you have a political problem at the Fed with this scandal. Maybe that could have gotten less attention when it was the two regional Fed vice presidents, or not vice presidents, but presidents that were caught in this scandal. But having it on the board of governors itself, so this Richard Clarida, having done these illegal trading activities, it's very politically costly. And usually you would expect that Biden would have nominated Powell already for a new term at the Fed governor, which ends, as you know, in early next year. We haven't seen that. So I think the odds have really increased with this last round of scandal with Clarida being caught doing these trades that we see. For example, Brainerd, who's seen as the likely alternative to Powell, and she's Democratic. Let's not forget, this is a very politically charged times we live in, that she becomes the new Fed chair. Does it really mean anything in terms of what the Fed policy shapes up to be? I don't really think so. But the market will react to it. Supposedly she's more dovish than Powell would be. So there could be a reaction point when if and when that news item becomes clear. But yeah, we'll have to see. But we're running out of time here, as we need to know who who the new nominee will be.
Well, the outrageous predictions by Saxo. If I would, have this audited to the 2021, so I mean, we still have at least 2 months to go, 3 months to go. So what has happened, what has not happened, because you make it in the beginning of the year, and which ones I think of the 2021 outrageous predictions should actually be rolled over to the next year?
Yeah, to run down the list, I think I would have to have the full list in front of me, but I think with the outrageous prediction, it's not even about keeping score. It's about trying to touch on key issues that could really cause something very disruptive to happen. That's the whole reason we call them outrageous. To open and expand our ability to think about what might happen. And I think one of the themes we looked at, for example, was the cost, for example, of doing alternative energy. There was something about silver prices doubling. Well, the silver price has not done all that much this year at all. But the idea behind it was very interesting. The idea that to do all this alternative energy, you need to have much, much higher prices. And we're realizing that, look at our energy prices right now. We don't have enough. There's just the physical world isn't there to supply even our fossil fuels, much less this so-called green energy that we're supposed to be getting. So I think we've touched on some key themes with our outrageous predictions. But I'm sure if you to the letter put a score on them, we're probably about 0 for 10 at this moment in time.
Well, in this regard, speaking of the short term, recently, John, I think you said that in the Q4 of this year, you are seeing, again, high levels of oil prices. So now that we're here, for Russia, because for Russia it's all about, oil, Russia is very, very sensitive about it. Yeah, will it continue? Will the high oil prices continue, do you think?
Well, I think what you're saying with the recent spike in natural gas prices is that the supply situation is very tight, and this is global. Natural gas became a global market. It used to be a localized market because of lack of transportation. With LNG, it's become a global market. So natural gas is already very constrained, and some of that links back to coal. So it's the whole energy complex that's tight right now. So we can see the risk of considerably higher prices. I am the FX strategist. Our my colleague Ola is the expert on commodities. But generally, given what we're seeing here, the pressure is higher. And when you have natural gas prices as high as they are, you get substitution wherever people can do it. For example, to burn oil instead as a substitute, where they can, burning diesel for power generation, etc. When you have natural gas prices at several multiples of where they have been historically. So we see pressure. There was underinvestment when oil prices collapsed back in 2015, 14 and 15. If you recall, the 3 years prior to that, oil prices were very high. Many companies made gigantic investments, and prices for services and other things in the sector shot up to incredible levels. All these billions did not even result in good gains in production, and then the price collapsed. And when the price collapsed, investment also collapsed. And now you have a world that's coming back online. Demand is coming back in part because of stimulus and because of the neglect on the investment side. You're not seeing the output able to rise to meet the demand. So we have a huge issue on our hands, and that issue is only solved by higher prices, and that's generally what we see now. Maybe natural gas prices aren't going to go back to where they were a few days ago, but there's still high prices relative to historic levels, also in oil.
Well, maybe I'm overestimating the role of the Fed, but seems like in this particular situation, the Fed will do whatever it takes for the dollar index to go up. And in August, I was saying that it will go to 94 and 95 in October. That was my outlook in October. But recently I see that, John, by the way, you too, basically talking about the fact that, the dollar by end of the year will be quite high. So trying to understand your rationale here, please explain.
Yeah, I think the world has a hard time adjusting to a Federal Reserve that's normalizing policy. They do as careful a job as they can to roll out this idea, but it's something we need to adjust to. Tighter Fed policy. It is coming. We all know that. It means a slightly stronger dollar by itself. But this adjustment is also going to mean, and because of dynamics in the Treasury market, that we're going to need to see more Treasuries being issued, which will mean higher interest rates. And that combination, the higher interest rates, which the market is not ready for, because we've all been led to believe that the central banks are always there. They're going to do QE forever. Long-term interest rates have been super, super low. But with all these inflationary pressures, with inflation, with Treasury issuance increasing again, we're going to see higher rates. And that's going to be more market volatility. And more market volatility tends to mean a stronger dollar. Now, it doesn't have to mean the stronger dollar is stronger against everything, but just generally a stronger dollar. And we still see long-term a weaker dollar, but for the short term, these factors, I think this adjustment process is going to see at least a firm dollar. I'm not predicting a very strong dollar, just a firm dollar, a resilient dollar that's not going to weaken in the near term.
Well, if I'm not mistaken, I think it was you, or maybe it was one of your colleagues from Saxo. I think someone mentioned that in Q4 the dollar will actually make bears' lives impossible in total before I actually wrote back. So can you actually maybe elaborate on that?
What I meant by that was basically what I said, that the dollar will have a hard time falling. And so there have been many dollar bears out there for quite some time. Some very dramatically so, very dramatic bears. The dollar just hasn't sort of collapsed, and it actually strengthened instead. And now we have the market starting to get, arguably the bears are already suffering, but I think they're just going to continue to not really see their point coming across. That's all I meant by that comment. I didn't mean to say that the dollar is going to launch a huge new rally, just that it's just this whole process of getting a weaker dollar is a very difficult process.
In the meanwhile, speaking of Saxo Bank's official stance, inflation will continue to rise, and the fact that the Powell said that the dollar inflation is transitory and we have it under control. I believe that Saxo Bank doesn't share this idea by the Fed, that it's transitory and under control.
That's correct. And in fact, the Fed is starting to believe that as well. You see them sort of slowly dropping their mentions of transitory inflation. And what is transitory? Is that 1 year? Is that 3 years? We'll find out. But this inflation is not transitory. We do not have a big enough world physically, and we did not make the investments to keep prices down for basic goods. And so we have fiscal policy or monetary policy that can do whatever it wants to get asset prices to go up and down. That's fine. But what about prices for goods? How do you affect the prices for goods? You either have to increase supply or you have to kill demand. They're not going to kill demand, and they can't increase supplies. The Fed can print money, but it can't print natural gas. It can't print crude oil. It can't print copper. It can't print iron ore. And then on the fiscal side, if they want to just give everybody a check like they did during the stimulus, that doesn't produce natural gas, oil, iron ore, etc. If they want to address supply problems, they need to make the tough investments and do something that's more visionary in terms of replacing energy systems, etc., related to the climate agenda, what have you. But if they're not making those investments, they're just sending everybody a check. That just goes straight into inflation. And monetary policy is totally irrelevant for getting these for the investments needed in this space.
Well, based on that prerequisite, Russia traditionally, of course, by simplifying and saying that there's this giant bubble, right, and therefore the market can just burst and just collapse. But I believe that it's not that black and white, and the fact that the stock market is living in a parallel universe, it's not necessarily one-to-one versus the actual, oh yeah, for sure the market will burst. I personally don't believe that it's so simple and black and white. What do you think about that?
I totally agree. The market is not just the market. There's pockets of the market that I think are bubbles that are going to pop, but that's just pockets of the market that got extremely overvalued during the run-up. In fact, some of these areas have semi-popped these speculative bubbles, and everything from alternative energy, some of the crypto-related things. But if you look at the broader market, so you have highly speculative, you have momentum and growth stocks that are very, very sensitive to interest rates. And if interest rates go up very fast, some of these could come down quite a bit, not a crash, come down quite a bit. But then your value stocks, those that are do well in a higher interest rate environment, should go up. So we can argue, yes, that the returns should be weak for a number of years in real terms. But the internals of what's going on inside the market, there's not everything crashing and everything rising simultaneously. And I think that's actually makes for a much more interesting environment over the next many years. But there is no doubt we are in extremely, if you just look at the headlines of the market valuation, we're in a very, very overvalued market, certainly in the US.
Well, in this regard, and again, maybe I'm talking about the Russian stereotypes and cliches that, oh, you gotta cash out, stop investing, sell. But I don't believe that, and I think that John, you also believe that. But that is not to say that you should actually keep investing the way you should. Yeah, it's not just riding the wave, but you need to think differently. Does it mean that now is the time where asset management will actually win over asset allocation, that you need to be smarter, you need to be more mercurial, and not just being an investor, but maybe more speculative and maybe smarter and more pivotal in your strategies?
Yes, I mean, what we've seen since over the last 20 years is the rise and dominance of so-called passive investing, where you just invest in an index and that there's no thinking involved, and it's been impossible to beat these strategies because of the tsunami of money that gets allocated every month to just buy the market. But yes, at some point this becomes self-defeating. You get too much money allocated in such a behavior to areas of the market that don't deserve that kind of investment. So there will be some kind of wake-up moment. Maybe it's pressure from commodities prices, inflation, and yields that provides this aha moment, this wake up moment. I think that's quite likely. And I think inside the next 2 to 3 to maybe 5 years, we will see a different investment. And people, if the mental model that it's always best to be passive breaks, you're going to see a tremendous amount of churn and change of behavior. But trying to figure out when that moment happens, it's so difficult. It just feels like we're onto something big here with an inflationary environment that is not transitory, and with nominal yields that actually start to rise as well. That provides a whole new set of pressures that really hasn't been there since decades, really. So when interest rates started falling in the early 1980s. So that's one of the reasons behind the title of our Q4 outlook, which is this time is different. It's never different, but it's different from what we remember in the modern era of investment. The idea that the yields can rise persistently.
Well, does it mean that the investors are supposed to actually be smarter, train more, learn more, study more, right, and be always part of this flow, the news flow, and be pondering all the time, right, and be learning all the time?
That should always be the case, but maybe more than ever, because it's been awfully easy to just be a passive investor for so long. But if we're right, that era is ending. So these skills will be certainly more required than they have been for quite some time.
Well, and traditionally at Finversia we give monthly outlooks on potential moves for the ruble and for the dollar index. And it's almost always a question, basically, Russians always wondering, why you're not talking about the euro? And we said that, well, we don't see euro as an independent unit, right? And therefore, the euro versus the dollar and euro versus the ruble depends on the dollar movement. Well, the question is, from the other side of the world, where do you see the euro? Is it true that euro is basically a very passive kind of a sort of immovable thing that is like so deep into the ground that you can't really do anything about it? Or is there something else that we're not seeing?
I think it's fair to say that the euro outlook has been very suppressed and kept weak. The euro has been kept weak by a very, very aggressive ECB that started under Draghi, of course, and especially with the move into permanent quantitative easing in early 2015. But we see some opportunity for more dynamism on the European side of things as soon as later this year and even early next year. If you look at Europe as a continent where it is politically, it never politically solved the structural problem of the EU. It never created a real foundation for the euro, which is to have a single, you have a monetary union, but they don't have a fiscal union. And we're going to need to see more fiscal union, and we're going to need to see more fiscal stimulus of good quality. Two big ifs, two big things we need to see, but this is what we need to see a more dynamic euro. And we think it may be underway. And I actually think that this current crisis we're seeing in Europe right now with energy prices could really provide a kick or a spark for much needed investment in Europe's energy infrastructure, electricity infrastructure, and so on. And I think this German coalition is going to move forward. We need to get to the other side of the French election as well, but I think 2022 could prove a bit more interesting for the euro and a bit more dynamic, and we could see a stronger euro if this plays out as it could do, with more fiscal stimulus, more dynamism, more focused on building something in Europe rather than doing nothing, really, which is what Europe has mostly been doing. But some things need to happen, yes, for this to come about.
In this regard, I was wondering, so the ECB recently has actually updated their GDP outlook 5%, and they actually set a really high benchmark, like 4.6 for the next year, right, the 2022. But for the 2023, they actually showed 2.3, which is basically lower than 2021. Why? I was wondering, is it something that they're seeing from the economical standpoint, or is it just a hint that, hey, in 2022, we're going to continue to provide QE, but then in 2023, so we're going to be done with QE, and therefore the GDP will show a lower rate? Or is it that they're going to do something on the ground, and maybe that's why the nature of the European Union will change fiscally?
Yeah, I think it's mostly a bit more simple than that in terms of what their model is trying to do. And their model is trying to say that of course we had the pandemic dip, and that was very traumatic. We had stimulus, and with that stimulus and resumption of activity is supposed to get us back to so-called trend growth for Europe. And so the initial part of that process is very rapid, but then once you get back to trend, let's not forget Europe was very lucky if it ever had anything that looked like 2% growth before the pandemic. So I think it's just a recognition that if we do manage these quick growth spurts to get us back to trend, trend growth is about the best we can expect after that. And some of these forecasts I think are quite optimistic for next year if inflation levels remain as high as they are. They may claim 5% growth or whatever, but what is the real growth after inflation? It may be a little bit lower than that, but we'll see. But I think that's the explanation for the sort of lower or sort of standard trend growth rates further out into the future.
Well, in this regard, I was wondering, just recently I looked at the Barclays Bank outlook, and I was quite happy about it because it matches my viewpoint. So Barclays say that you need to buy European stock, so in terms of if the market collapses, because in the midterm perspective, Barclays see a very strong upside for the European stock, so you can buy them on a dip. I mean, not all across Europe, but with a few exceptions, but generally. So in your mind, looking, from a layman's standpoint, would you subscribe to this recommendation to actually buy European stocks on the dip?
I'm the FX strategist, not the equity strategist, so I would defer that question to Peter, but please do pass it along to Peter. But I think the idea, and certainly the valuations are much lower in Europe, but that's also because Europe has, to a large degree, has missed whole industries that have been shown, the majority of growth in the world and profits, importantly, in the world. And that is, of course, the big infotech platforms that you see in the US. These companies have been the big growth dynamos in terms of bringing in profitability. So, yeah, valuation-wise, yes, but there's a reason they have lower valuation. The growth potential is perhaps a little bit lower as well. So, but I wouldn't want to make a firm statement on the outlook for European equities.
Well, in that case, let's go back to the euro. Maybe it's a naive question, but quite recent, in the past 10 years, a couple of decades, we've seen this situation, like an assumption that the dollar-euro parity, on the one hand, or 1 versus 1.5, dollar versus the euro. So these extremities, are they still valid? Are they still relevant or not?
Well, there's always a drift in terms of exchange rates. So if you have a Russian ruble paying 7% plus on a policy rate, if you have a Turkish lira paying 19% and much higher inflation in Turkey than in the US, or than in Russia than in the US or in Europe, there's always going to be a drift that represents the valuation, the real value of that currency in terms of buying power, in terms of inflation. So of course, the levels are smaller between the US and Europe, but there is a drift there as well. And that actually means that the fair value of Eurodollar actually sort of slowly climbs over time, and is probably more like 120, 125 now versus, let's call it 115, 117 some time back. So the euro is already pretty cheap. And the parity means it's wildly cheap compared to when it was at parity back in, let's call it 2002. So in terms of natural levels, there's just always a drift. Yes, psychologically we have these levels that we keep in mind, but I think that drift is important to keep in mind. The CPI adjusted sort of exchange rate and sort of equilibrium rate, if there is such a thing, drifts a little bit higher all the time.
And probably the last question about the effects, but it's this really big one. During the negotiations between Beijing and Washington, when Trump was president, the whole trade relationship before they actually, started to finalize the trade relationship. Well, Trump's claim against the Beijing was that they actually devaluing their national currency. And there's a sense that Beijing sort of undertaking this unofficial, responsibility to not do it again, right, to behave, so to say. Right. Well, clearly, of course, that with the Biden administration, that might say, well, no longer relevant. But can we expect from Beijing a predictable FX currency, or will it go back to square one like 5 years ago, where the market will just wake up and then the People's Bank of China, lo and behold, drops their yuan again? So where do you see this policy?
It's a great question and an important question. I think what we've seen from recent history is that China wants to keep a fairly strong and stable currency. And especially so now that we have these very, very high commodity prices. So it keeps the import costs, rising import cost pressures somewhat lower than they would be otherwise. But if the Chinese currency gets too strong, then it's affecting their exports. But what we've seen is that tends to just move up and down with the US dollar. So you have this idea that they're almost, these two economies are so joined together that exchange rate has to stay stable. So I don't think you can argue that they're artificially keeping their currency to the weak side anymore at all. And in fact, if they were doing so, you would see big rises in Chinese reserves, FX reserves, and otherwise. China is dealing with, at the same time, China is dealing with a huge financial situation, potentially systemic crisis, in dealing with too much leverage in its real estate sector. But that doesn't really have any exchange rate consequences, because really they could just blow that whole thing up and they just need to revalue prices internally, because most of that debt is held internally within China. So it's not reliant on funding from outside of the currency, from outside of the country. So China is trying to change its system to a more high-tech, high productivity sectors, high value exports, and moving away from the lower quality stuff that it can see is going to get, the cost pressure, the wage levels and the costs in China.
But does it mean as a conclusion that you can expect a more predictable yuan policy from the Chinese government from now on?
That's the impression they want to give, and I'm willing to take it at face value for now. I think they would prefer to also, because it'll attract capital longer term into the country if they're keeping a credible and stable currency. So I think that's just they're going to maintain that policy as long as they can, and as long as it brings stability and is effective. So far, it seems to be doing fine.
Well, and maybe maybe I'm just looking at the crystal ball. Now, for the next year, what would be the safe haven currency and maybe the surprise currency? I believe that the Swiss franc is the safe haven currency, but for the surprise currency, I don't even know what it is. But what about you? The safe haven versus the surprise currency. It's not an official outlook. It's just, out of the blue. It's just that you are just out of thin air.
Well, I think the dollar is the safe haven currency, and especially if U.S. interest rates are rising. Until the Fed goes in and stops that process and blows up its balance sheet, as long as the yields start to rise again, I think the dollar remains sort of a safe haven currency in times of trouble. And you've seen that with this dollar yen move, by the way, US dollar versus the Japanese yen, rushing to the upside on the smallest increases in US yields. Now, in terms of the surprise currency, that's a great question. And because I haven't prepared anything, I don't really have anything for you there, but something like the Australian dollar, a very hated currency right now because of the pandemic, because nobody expects the RBA is going to do anything. Well, what if we do decide to do all this climate stuff and we suddenly need twice as much copper? There's some pretty good mining companies in Australia. Or what if we build a lot more nuclear and we need a lot more uranium? or other key metals or minerals. Well, Australia's got a lot of that kind of stuff too. So just relative to where sentiment is right now, you ask for a surprise. People are very, very bearish on the Australian dollar. So I think that's an interesting one to look at as a contrarian bet relative to where we are right now.
Well, John, thank you so much, and we're always looking forward to seeing you again. And of course, let's not forget, and this is for the audience, the outrageous outlooks by Saxo Bank and also quarterly outlooks by Saxo Bank. There's a lot of food for thought, so stay tuned for that. Thank you so much.
Super. All the best. Thank you. Thank you.
Легко принимать решения, зная о происходящем. Финансовые новости, мнения и аналитика от экспертов. Прогнозы и их исполнение. Важные события и актуальные возможности инвестиций. Будьте в курсе событий мира финансов с телеграм-каналом портала Finversia. Подписывайтесь на телеграм-канал, инвестируйте сознанием происходящего. Ссылка на регистрацию в описании под видео.